The American dream didn't fail. It was quietly converted into a rental business model. May 2024. While every financial news outlet was publishing think pieces about BlackRock buying up America, a different firm quietly closed a $3.5 billion deal. Blackstone, not BlackRock. The names are similar enough that most people never caught the switch. A rock is something you trip over. A stone is something you build with. While everyone argued about the rock, Blackstone was laying the foundation, one house at a time. 38,000 homes, transferred from public market transparency to private institutional control in a single transaction. Statistically, that means this transaction likely included a home within 20 minutes of where you live. This wasn't announced with fanfare. It wasn't protested. Most people still don't know it happened. The Tricon deal is now complete. Combined with their earlier $6 billion acquisition of Home Partners of America, Blackstone controls over 60,000 single-family homes, the third largest landlord in the country. These aren't apartment complexes. They're the 3-bedroom, 2-bath starter homes where families used to build equity. Now they're rental units. Permanently. The question isn't whether Wall Street is buying homes. The question is, who let one firm privatize entire neighborhoods while everyone was watching the wrong company? By the end of this, you'll understand exactly how this one deal changed the math on every starter home in America. The golden handcuffs, why the market is frozen. The housing crisis isn't what you think it is. There isn't a shortage of homes. There's a shortage of available homes. The difference matters. During the pandemic, mortgage rates dropped below 3%. Families locked in historically cheap financing. Then the Federal Reserve started hiking rates. By 2024, new mortgages were running 6.5% to 7%. Here's the math that broke the market. If you bought a house in 2021 with a 3% mortgage, your monthly payment on a $400,000 loan is about $1,686. If you sell that house today and buy an identical one at current rates, your new payment jumps to $266.61. Same house, same price, nearly $1,000 more per month. That's not inflation, that's a mobility tax. A $1,000 a month penalty for daring to move. The lock-in effect turns homeowners into hostages. This makes it look like there aren't enough houses, but the houses are there. They just aren't for sale. In 54% of markets, you need a 6-figure income just to qualify for the entry-level stock. And this is where the game stops being fair. While families are trapped by interest rate math, institutional capital is moving freely. The lock-in effect that paralyzed individual buyers created the perfect environment for institutional acquisition. Families couldn't move. Investors could. And they did. Investor purchases hit 33% of all home sales in 2025. The highest level in 5 years, not because demand from families disappeared, but because families were structurally locked out of competing. The market didn't freeze for everyone. It froze for you. While you're calculating whether you can afford the payment shock, institutional investors are siphoning the inventory that used to build middle-class wealth. Blackstone saw the same interest rate environment and made a different calculation. They looked at a market where individual buyers were handcuffed by financing costs and realized they could acquire at scale without competition. The Tricon deal wasn't opportunistic, it was surgical. Not mansions, not luxury condos, starter homes. The 3-bedroom, 2-bath properties in suburban markets where first-time buyers used to build equity. The lock-in effect didn't just reduce inventory, it transferred an entire asset class from individual ownership to institutional control. And once Blackstone owns it, they're not selling it back. The Blackstone playbook, surgical acquisition. The Tricon privatization wasn't random. It was the culmination of a strategy that started years earlier. In June 2021, Blackstone Real Estate Income Trust acquired Home Partners of America for $6 billion. At the time, Home Partners owned 17,000 single-family rental homes across the United States. 3 years later, Blackstone announced the Tricon deal. Another $3.5 billion, another 38,000 homes. Combined, that's nearly $10 billion deployed to consolidate control over the starter home market in just 3 years. Then in mid-2024, they started winding down Home Partners as an independent operation. The entire portfolio is being folded into Tricon's management structure under unified control. The infrastructure is identical, but the footprint has doubled. The combined entity now controls over 60,000 properties. That makes Blackstone the third largest single-family landlord in the country, behind Progress Residential, with 85,000 homes, and Invitation Homes with over 80,000. But the raw numbers don't tell the full story. Blackstone isn't buying randomly. They're targeting specific inventory. The homes they acquire aren't luxury estates or high-end condos. They're the entry rung of the wealth-building ladder, the homes first-time buyers used to purchase to build equity and financial security. Blackstone is systematically removing it. The geographic concentration reveals the strategy. While institutional ownership nationally hovers around 1 to 3%, certain hotspot markets tell a different story. In targeted metros, institutional investors control 12 to 25% of the single-family rental stock. Phoenix, Atlanta, Charlotte, Tampa. These aren't just cities, they're yield-rich battlegrounds. Markets where population growth is strong, job markets are stable, and rental demand is high. Blackstone identified these territories, moved in with precision, and deployed capital to dominate specific regional markets before local buyers even realized what was happening. And they're not stopping with existing homes. Blackstone committed $1 billion to a built-to-rent pipeline through the Tricon acquisition. This isn't about buying existing inventory. It's about becoming the developer. These are single-family homes being constructed specifically to remain rental units forever. From the foundation pour to the lease signing, these properties are designed to extract rent, not build equity. The competition is eliminated before it begins. Families can't bid on inventory that will never be listed for sale. This is the capital depth advantage that makes competition impossible. The privatization of Tricon was critical to this strategy. When Tricon was publicly traded, they had to answer to quarterly earnings reports and dividend expectations. Short-term pressure, public scrutiny. By taking Tricon private, Blackstone removed those constraints. They can now play a long-term monopoly game that public companies can't afford. No quarterly dividend pressure, no activist shareholders demanding immediate returns. This is patient capital with a 30-year horizon. They're not flipping properties, they're building a rentership infrastructure that will extract wealth from the same homes families used to build equity in. The scale creates operational advantages individual landlords can't match. Centralized maintenance, bulk purchasing power, algorithmic rent optimization, institutional-grade property management. But the real advantage is simpler. Blackstone can outbid you every single time. They close in 7 days. All cash, no financing contingencies, no inspection drama. Sellers take their offer because it's clean, fast, and guaranteed. A family with a mortgage needs 45 days to close. They need appraisals, inspections, underwriting approvals. Any one of those can kill the deal. 7 days versus 45. Cash versus contingencies. Certainty versus risk. Blackstone's offer doesn't have those vulnerabilities. But speed is just the execution advantage. The real weapon is knowing which properties to target before they're even listed. The Tricon acquisition wasn't just about adding homes to a portfolio. It was about consolidating control over an entire asset class in specific regional markets. And once they own it, the math changes for everyone else. The yield monopoly, the unfair math. The speed advantage is just the surface. The real weapon is structural. Blackstone can outbid you on the same house and still generate higher returns. Not because they're smarter, because the tax code and financing markets are designed for institutional capital. Here's how the math breaks. When you buy a home, you're building equity. Your mortgage payment includes principal and interest. Over time, you own more of the asset. The wealth-building component is the equity accumulation. When Blackstone buys that same home, they're not building equity. They're harvesting yield. The house generates rental income. That income flows to their investors as returns. The property appreciates over time, but the real profit is the rent stream. The difference is the tax code. This is where the game gets rigged at the structural level. There's a rule called a 1031 exchange. It lets big investors sell a property and buy a new one without paying taxes on the profit. Technically, this rule exists for everyone. But here's the difference. When you sell your home, you usually pay taxes on any profit above $250,000, $500,000 if you're married. When Blackstone sells a property, they roll the entire profit into the next purchase. No taxes. Then they sell that one and roll again. No taxes. They can do this forever across their entire portfolio. For Blackstone, this is like a snowball that never stops growing. You pay taxes when you sell? They don't. The money keeps compounding without friction. The tax code doesn't just allow this consolidation, it actively incentivizes the player with the most properties to roll. Blackstone can sell a property in Phoenix, take the proceeds, buy 2 properties in Atlanta, and defer the entire tax liability, then sell those and buy 4 more in Charlotte. The compounding never stops because the tax liability never triggers. There's another layer, REIT structures. While you're calculating property taxes and mortgage interest deductions, Blackstone uses structures that bypass corporate taxation entirely. Real estate investment trusts pay no federal tax on profits. Individual buyers can't access this treatment. Add in depreciation schedules that offset taxable income, and the gap widens further. The system isn't neutral. It's designed to ensure institutional capital always has the advantage. Blackstone can pay more because their effective cost is lower. The tax deferral alone changes the return calculation. Add in depreciation benefits, and the spread widens further. Now layer in the financing advantage. Blackstone doesn't need a normal bank loan. When they do borrow money, they get special big company rates that you can't get. It's simply cheaper for them to borrow money than it is for you. Their terms are longer. Their flexibility is greater. A family buying a home in 2024 is paying 6.5% to 7% on a 30-year fixed mortgage. Blackstone's institutional financing comes in closer to 4% to 5% with better terms and fewer restrictions. That gap compounds over time. Lower financing costs mean higher net returns on the same rental income. Then there's the improvement fund. Blackstone announced a $1 billion capital commitment to upgrade their existing rental stock. New HVAC systems, kitchen renovations, landscaping improvements. They're investing at scale to increase the quality and rental yield of properties they already own. A family buying a starter home scrapes together a down payment. They're tapped out. Any improvements come out of pocket over years. Blackstone writes a $1 billion check and systematically upgrades 60,000 properties. The rental income increases, the property values increase, the yield improves across the entire portfolio. The algorithmic targeting is the final piece. Blackstone uses powerful computers to find the best neighborhoods before anyone else. They don't guess. They use data to see where prices will go up. They know which areas are getting better. They know which school districts are improving. They know where new roads and buildings are coming. They buy before a for sale sign even hits the grass. Individual buyers rely on Zillow estimates and realtor advice. Blackstone has entire teams running acquisition models that process millions of data points in real time. The result is they're not just outbidding you, they're outpositioning you. They're buying properties you didn't even know were available yet. This isn't a fair fight, it's a structural mismatch. But the unfair math is just the mechanism. The real goal is much more permanent. The quiet transition from a nation of owners to a nation of permanent tenants. Blackstone isn't cheating, they're playing by rules that were written for them. The new feudalism, what happens next? 67% of Americans now believe home ownership is impossible. That's not pessimism, that's pattern recognition. The social contract that defined the American middle class for generations was built on property ownership. You worked, you saved, you bought a house. That house appreciated, you built equity. You passed wealth to the next generation. That compounding engine is breaking down. When a third of all inventory is siphoned off by institutional capital, the entry rung of the American dream effectively ceases to exist. The wealth-building ladder that defined upward mobility isn't just broken, it's been pulled up entirely, and the same generation that used it to climb is now being asked to pay rent to the firms that bought the rungs. The starter home stock that used to be the entry point is now institutional inventory. Millennials and Gen Z are locked out of the same mechanism their parents used to build financial security. This isn't a temporary market correction, it's a structural transition. The rentership state is being normalized. Built-to-rent communities are being marketed as lifestyle choices. Flexibility, no maintenance hassles. Amenities included. The messaging is designed to make renting sound like a preference instead of a necessity. But the economics tell a different story. Renters don't build equity. Every monthly payment is pure expense. There's no asset accumulation, no wealth transfer to the next generation, no leverage for future financial decisions. Home ownership wasn't just about having a place to live, it was economic sovereignty. Property ownership gave you stability, It gave you collateral. It gave you a stake in the appreciation of the asset. Renters have none of that. They're price takers. When Blackstone raises rent, they either pay or leave. There's no negotiation, no equity cushion, no exit strategy. The control mechanism is complete. A rentership economy creates a permanent tenant class with no leverage and no path to ownership. The homes that used to be owned by families are now owned by institutional landlords, extracting perpetual rent from the same properties that used to build middle-class wealth. The generational trap is already visible. First-time homebuyers are aging out of the market. The average age of a first-time buyer is now 35. It used to be 29. That 6-year gap isn't just a delay, it's the theft of your most powerful compounding window. It's the loss of 3 decades of growth, the same equity cushion your parents used to fund college, upgrades, and retirement. Those years are gone, and the system that took them isn't giving them back. And the gap is widening. What does financial independence mean when the foundational asset class is controlled by Wall Street? When the homes themselves are off limits? When ownership becomes a luxury reserved for those who already have capital? The system isn't broken. It's working exactly as designed. Institutional capital was always going to win this fight. The financing markets favor it. The most dangerous part isn't that this happened, it's that it happened quietly. Understanding this mechanism is the first step to navigating around it. If you want to see how this connects to the broader economic reset, watch this next. Subscribe for investigations that follow the money, not the headlines.